We are awaiting the consumer price index later this morning. Our next guest says she expects inflation to remain benign. Joining us now, Julia Coronado is the founder and president of MacroPolicy Perspectives. Good morning, Julia. Great to get your analysis on this. You're expecting it to sort of allow the Fed to go ahead and cut rates in September?
Yeah, we're looking for both headline and core inflation on an annual basis to move a tick lower, and for the composition of core inflation to be a reassuring factor for the Fed. In other words, they've been watching for months and months to see if housing inflation would step down. It has been. We expect that to continue in the July reading. Ongoing deflation in car prices and other goods prices, and just a generally sanguine backdrop for core inflation and even headline inflation. So that should keep the door open. We think the door is already open for a September rate cut. Now the question is around pace. We think that has more to do with the labor market than inflation, but inflation needs to check the box. And we do expect the data will check that box to keep the door open for bringing rates back towards neutral.
Mm-hmm. Chair Powell in the press conference said that the Fed will be data dependent and not data point dependent. And here we are scrutinizing a data point. And so I'm wondering what you think sort of the acceptable range would be. I think markets are trying to struggle with, if it comes in a little bit hotter, if it comes a little bit cool, like what does that mean for how the Fed acts?
Right, exactly. Obviously, downside surprises just open the door wider, don't probably have much effect on pace considerations. But if it were a lot stronger, and in particular, I think if housing inflation were to firm up again, that would be a source of concern, at least for some on the committee. I think right now, Chair Powell's assessment is that given the growth backdrop that is moderated, given the labor market backdrop that has cooled considerably, that, the time is now and he's ready to recalibrate. But he's got a big committee that he needs to maintain on board with that direction of travel. And that, about half of them have been a bit more skeptical, have a little bit more scarring or PTSD from being behind the curve when inflation was going up, and are more inclined, unless there's something really, really worrisome in the labor market, to make sure that inflation is really back at 2%. But again, as Chair Powell has said, if you wait until inflation is back at 2%, you've waited too long. If you wait till the labor market is outright weak, you've waited too long. So that's the needle he's trying to thread as the leader of this group. I think the data will be supportive and help him. But, again, a meaningful upside surprise, a 0.3 or a 0.4 on core inflation could make that a much heavier lift for him.
Speaking of PTSD, a lot of your counterparts at various shops on the street were really quick to change their forecasts or rate cuts on the back of one data point. That would, of course, be the jobs report. And I'm wondering what your sort of reaction is. And I say PTSD because this whole year has been a very difficult one to forecast. And so it felt like economists were worried that they were on the wrong side of the boat, so to speak, once again when it came to the cutting cycle. What do you think actually happens in terms of the pace and just the flow of the cuts?
So what we know from the Fed's own forecast is that they have laid out for us a gradual pace of rate cuts, basically once a quarter or every other meeting, 25 basis point rate cut. That path was based on the assumption that the labor market would not weaken any further, that you would basically have trend-like growth and a very resilient, solid labor market, but cooling inflation, and then you would go through this gradual recalibration lower in rates. What we've seen in the labor market is more weakening. Now, there's a lot of special factors in the July employment report. They will get August before the September meeting, but not before Chair Powell's Jackson Hole speech. So I think that, take aside the special factors in the July report. There's been cooling in the labor market for quite a few months now. For really the whole year, we have seen the pace of job growth slow. The unemployment rate has moved from a low of 3.4% a little over a year ago to 4.3% now. So that is something that, could tick lower in the August report, but you're still a lot higher than you were. And I think Chair Powell has sort of sat up and take notice, and a lot of people on the committee, the dovish half of the committee, has already sort of drawn a line in the sand. This is fine, the labor market's fine, but we really don't want to see it weaken further. That's a different scenario. So we're in a different scenario than they laid out in their June forecast. The labor market has moved further, and it has cooled further. So now there's not as obvious a reason to be this high on rates. You want to get towards that neutral stance a little bit quicker. So we're looking for Chair Powell to lay out kind of a two-stage strategy. One where they go a little bit steadier in the first phase, and then they can slow down and feel their way in the second phase. But it will be data dependent at the end of the day.